Today, we explore why the IFSCA board approving a global commodity trading platform at Gift City matters for Indian markets, investors, and the global supply chain. The move signals a structural shift toward a regulated, centralized venue that could reduce transaction costs, overnight risk, and reliance on opaque international exchanges. As commodity prices swing with geopolitical shocks, this platform promises clearer price discovery, faster settlements, and improved transparency for both buyers and sellers. From steel to soy, risk management strategies will hinge on trusted data, robust clearing, and credible oversight within a Delhi-backed financial hub. Its success will ripple across banks and markets. At its core, the project creates a sanctioned venue where buyers and sellers can execute contracts for commodities like crude oil, metals, grains, and energy products, with real-time price feeds, standardized contracts, and a single clearinghouse. Instead of fragmentary trades across multiple exchanges and unregulated platforms, participants would place orders on a unified system linked to risk controls, margin requirements, and settlement rails. Regulators argue this reduces counterfeit deals, boosts market integrity, and lowers the cost of risk for hedgers. The end result should be a transparent, scalable market infrastructure compatible with both domestic and international participants globally. Historically, Indian commodity markets relied on scattered exchanges and over-the-counter trades with varying quality data and settlement speed. The international push toward globalization spurred exchanges to upgrade back offices and risk controls after the 2008 crisis, but many emerging markets still faced opacity, price manipulation risk, and slow clearing. Gift City in Gandhinagar has positioned itself as a fintech and financial services hub, drawing licenses and cross-border connectivity. The IFSCA earlier established a unified regulator for securities, commodities, and banks in one jurisdiction, promising easier license access and faster approvals for new trading products. Its evolution mirrors global shifts towards centralized risk management. Markets are passing the news as liquidity providers and hedgers recalibrate. Indian equity futures and commodity indices often react to regulatory milestones, and this clearance has boosted sentiment toward risk management assets. Traders expect sharper price discovery on a global platform insulated by trusted clearing. Some brokers are predicting higher trading volumes as participants consolidate across vendors, reducing dispersion in quotes. Importantly, cross-border trading could broaden access for foreign funds, while domestic players test pricing models for new contracts. The short-term reaction includes tighter bid-ask spreads in related benchmarks and a tilt toward risk parity strategies globally. Big players include commodity traders, banks, mutual funds, pension schemes, and corporate hedgers across energy, metals, and agriculture. Oil majors and refiners may gain a clearer hedging framework, while producers face more predictable price risk. Farmers and grain exporters could access futures on domestic supply chains with lower counterparty risk. Banks and clearinghouses could expand margin financing and collateral networks, while fintechs offer API-driven connectivity and data feeds. International asset managers eye India as a bridge to Asia, but incumbents fear regulatory changes, capital controls, or mispriced risk while building compliance playbooks. Small brokers may lose some personalized service, while startups see chances to capture niche clients. Broader macro forces frame this development. Global commodity demand remains sensitive to supply constraints in the Middle East, Russia, and Latin America, while inflation trends influence interest rates and risk premium pricing. If India positions itself as a transparent hub, it competes with Singapore and Switzerland as regional centers, potentially reshaping cross-border capital flows. Trade tensions, climate policy, and energy transition costs will test platform resilience, as will currency volatility and cross-border settlement risk. The platform must align with global standards on anti-money laundering, data protection, and cybersecurity to avoid regulatory friction. Investors watch policy signals closely for guidance. Smart money is watching the regulatory pulse and adjusting portfolios accordingly. Institutional funds may begin gradual allocations to Indian commodity products, testing liquidity and risk controls before committing sizable capital. Retail investors might benefit from accessible futures or ETFs linked to the platform through existing brokers, while carefully evaluating margin requirements. Banks and asset managers are likely to run scenario analyses around volatility, liquidity stress tests, and cyber risk. In practice, traders could diversify across agri-based, energy, and metal contracts, aiming for skewed exposure toward hedging rather than pure speculation. The key is disciplined risk budgeting. Liquidity providers may tighten spreads to compensate. Every new market rails bring risk. Over-reliance on a single platform could create systemic concentration, and a bug in the clearing engine might trigger margin calls cascading through the chain. If liquidity lags during stress events, spreads could widen sharply, and counterparties may suspend trades. Regulatory forbearance or delays in cross-border settlement could hamper confidence, inviting regulatory scrutiny and capital flight. There is also a technology risk. Cyber attacks and data breaches could undermine price discovery, while mispriced risk from new contract types might lead to misaligned hedges. Finally, political cycles and policy shifts can reshape the platform resilience. For retail investors, the takeaway is patient-informed exposure rather than headline chasing. Start with education about the platform, its clearing safeguards, and the margin framework before allocating funds. Use diversified, low-cost vehicles such as broad commodity ETFs or index futures to gain exposure without concentrating risk in a single contract. Practice strict position sizing, set stop losses, and track liquidity indicators like bid-ask spreads and daily volume. Align your investments with long-term goals and avoid over-leverage during volatility shocks. Seek reputable brokers, test paper trading, and review quarterly risk dashboards. Patience and discipline are your allies. Looking ahead, the global commodity trading platform at Gift City could become a bridge between Indian markets and global risk markets, potentially accelerating price discovery and hedging efficiency. If the platform proves scalable and well-regulated, it may attract foreign liquidity while stimulating domestic risk management innovations across banks and corporates. The timing aligns with a broader push toward financial inclusion, digitalization, and data-driven decision-making. For investors, the message is simple: stay informed, diversify across assets, and monitor regulator updates. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.